Every cycle, the market relearns the same lesson in a new costume. When prices are rising cleanly and the mood is easy, people call it wisdom to buy. They say the trend is strong. They say the story is working. They say the future is obvious. Then the stock moves a little too far. Expectations get too hot. The market shakes, the chart cracks, the headlines turn anxious, and suddenly the same people who loved the business 2 months ago begin acting as though they have discovered some fatal flaw in capitalism itself. I have watched this for too long to be impressed by it. The market is not always trying to tell you the truth. Quite often it is trying to test your nerve. That is what I think is happening now. We are heading into a period where volatility has done what volatility always does. It has frightened the people who only liked these stories when they were easy. It has given the weak holder a reason to leave. It has handed the emotional investor a chart ugly enough to justify his surrender. And in doing so, it has done something much more valuable for the patient buyer. It has reopened the discussion about price. That is where all the money is made. Not in admiring a company, not in shouting about a theme, not in joining the right online tribe and repeating the right slogans about the future. Money is made when a good business, or the possibility of a good business, is offered to you at a price that finally compensates you for the uncertainty you are being asked to bear. That is why I care much more about resets than excitement. Excitement is expensive. Resets are useful. The list in front of us looks, on the surface, like 5 hot stocks for April, a media segment, a grab bag of names, some big, some speculative, some already beloved, some less obvious. Most people would treat that as a shopping list. I am not interested in shopping lists. I am interested in the map underneath the list. And the map here is very simple. The market has spent years building up a massive belief in AI, compute, automation, defense, adjacent intelligence systems, and the infrastructure required to support them. Some of those beliefs were justified. Some were overheated. Some were early. Some were priced for perfection. Then fear entered, macro pressure entered, conflict entered, rotation entered, profit-taking entered. Suddenly, the stories that looked unstoppable were no longer comfortable. That does not mean the stories and a change in price, if the business quality and long-term demand remain intact, is often the only invitation an intelligent investor ever gets. I have always thought the public misunderstands what a correction is for. They think a correction is there to punish them. Sometimes it is, but more often it is there to separate two groups of people who had been pretending to be the same. The first group owns a stock because they understand the business, the runway, the valuation, the risks, and the role it plays in a portfolio. The second group owns the stock because the chart was kind to them and the crowd was saying nice things. A correction makes those two groups visible. The first group gets quieter and more analytical. The second group starts asking if this is the end. I prefer the first group, and I think the first group is the only one that can make real money in what comes next. Because if you look carefully, what this list is really telling you is not buy 5 names because April is here. It is telling you that the market may have temporarily repriced some very durable themes while those themes are still unfolding underneath. That is a very different proposition. Let me begin where everybody always begins. With NVIDIA, it is almost impossible to talk about this period in markets without talking about NVIDIA because the company has become something more than a stock. It has become a symbol of AI, a symbol of scale, a symbol of what happens when one business captures the right side of an enormous wave early enough and with enough dominance that the rest of the market has no choice but to organize itself around that fact. What fascinates me about NVIDIA now is not that it became huge, That part is already well known. What fascinates me is how many people think a company stops being interesting just because the stock has spent months going sideways or because the chart no longer gives them immediate emotional gratification. That is one of the great misunderstandings of modern investing. A stock does not need to go up every week for the business to be improving. In fact, some of the best entries in high-quality growth come after a stock spends enough time moving nowhere that the market catches up to its own previous enthusiasm. I like that. If a company runs too far too fast, price becomes a problem no matter how beautiful the story is. But if the business keeps outperforming while the stock consolidates, while earnings estimates rise, while the valuation compresses, while the moving parts underneath strengthen, then what you are seeing is one of my favorite setups in markets, a great business getting cheaper relative to its own future. That is what is beginning to happen here. NVIDIA is no longer being priced with the same delirious multiple people were willing to hand it at the hottest point of the AI rush. The business, meanwhile, is still behaving like a business attached to one of the most powerful secular forces of the decade. Demand for advanced compute remains enormous. The hunger for GPUs remains extraordinary. The backlog dynamics remain robust. China, which had become a source of uncertainty, now threatens to become an upside variable again rather than a permanent drag. The company's growth, which by normal standards would already be considered absurdly strong for something its size, continues to exceed what mature blue chip companies are even allowed to dream about. That combination matters. A lower multiple and a stronger future is how high-quality growth becomes investable again. I should say something here that people often find offensive because it removes the magic from the story. NVIDIA is not a miracle. It is a toll road. And toll roads can be wonderful businesses. The market likes to dress it up in romance. AI revolution, future of intelligence, digital gold rush. All of that may be broadly true, but what matters financially is simpler. The world is trying to build a new layer of computing power, and NVIDIA sits at one of the most lucrative toll booths on that highway. Every company rushing to train models, scale infrastructure, build data centers, deploy AI systems, and stay relevant in the new competitive environment has to confront the same brutal fact. This stuff requires serious hardware, and serious hardware comes from a very short list of suppliers. That is a beautiful place to stand if the price is not insane. For a while, the price was getting uncomfortably close to insane. Now, after time and consolidation and broad rotation, the price is no longer sending the same level of warning. That does not make NVIDIA risk. Free, nothing does. But it does change the ratio between what you are paying and what you may be getting. That is why I care. Now let us move to advanced microdevices, because this is where the story gets more subtle and therefore more interesting. AMD has always lived in NVIDIA's shadow in the public imagination. That shadow has not always been undeserved. NVIDIA got there first in the AI infrastructure story, and with more obvious dominance. But markets are not static, and one of the most expensive habits investors have is assuming that the first winner must own the whole market forever. I have seen that mistake repeated in many industries. The market gets large enough that people begin treating second and third players as though their existence barely matters, until one day the market is so huge that being merely the credible number two still turns out to be enormously profitable. That is the case worth studying with AMD. What I see in AMD is not simply a cheap alternative to NVIDIA. I dislike lazy comparisons. The more valuable question is whether AMD is reaching the point where its product cycle, especially around its next-generation AI rack-scale offerings, can meaningfully shift the market's perception from future possibility to near-term inevitability. That transition is everything. There are businesses that spend years living on a promise and then never fully cross into durable economics. There are others that spend years being underestimated precisely because the market keeps saying, yes, yes, maybe later, until one release, one product cycle, one adoption curve, one revenue inflection begins forcing a repricing. That is what AMD feels like to me right now. The company's been in this awkward middle stage where the stock keeps surging on future imagination and then cooling off because the present numbers are not yet catching up quickly enough to justify the excitement. That is a frustrating place to own as a trader and a very interesting place to study as a long-term investor. Because if the product pivot really is near, then the market will not care much that the stock spent a year frustrating people. It will care that the revenue base and the role in the AI supply chain are moving into a much bigger category. In other words, this is not mainly a story about today's earnings multiple. It is a story about whether the business is about to graduate into a different economic league. If it does, then a lot of what looks expensive by backward-looking math will turn out to have been cheap by forward-looking math. This is why I never let the market force me into the wrong time frame. People want immediate neatness. They want current earnings to explain future greatness, before future greatness has shown up. But many good investments are made in the gap between what the present can prove and what the future is starting to reveal. AMD sits right inside that gap. I do not know whether every launch will go smoothly or whether every expectation will be met. I do know that the market for AI compute is so enormous that it may not require NVIDIA to weaken for AMD to become a huge winner. That is an important distinction. Investors often think in zero-sum theatrical ways because it is emotionally satisfying. One king, one throne, one loser. Real markets do not always work that way. When demand is this large, when hyperscalers are this hungry, when refresh cycles are coming, when existing data centers will need refurbishment faster than traditional infrastructure did, there can be room for multiple very large winners. And that is where AMD becomes interesting. Not as a rebellion against NVIDIA, as a second powerful beneficiary of the same megatrend, but at a point in its transition where the stock may still be pricing too much skepticism relative to what the product cycle could deliver. The third name, Nebius, is a different kind of animal entirely. This is not the established toll road. It is not the scaled challenger. It is the compute landlord building the physical capacity required to convert AI demand into recognized revenue that makes it much more volatile. It also makes it much easier to misunderstand. A lot of investors look at a name like Nebius and see debt and immediately recoil. I understand that instinct. Debt has ruined many stories. But debt is not one thing. Debt used to subsidize delusion is very different from debt used to fulfill demand that is already waiting on the other side of the build-out. That distinction matters enormously. If a company is borrowing to build castles in the air and then hoping customers show up later, that is dangerous. If a company is borrowing because the demand backlog is already there and the revenue cannot be recognized until the infrastructure exists, that is a different story. What you have then is not speculative debt in the lazy sense. You have build debt, capacity debt, infrastructure debt. That is still risky, of course, because execution matters. A company can still stumble. Delays can still happen. Capital markets can still turn ugly. But you should not talk about those two forms of debt as though they mean the same thing. They do not. What appeals to me about Nebius is that it represents the application layer of the AI boom in physical form. Everyone is talking about chips, models, software, and platforms. Fewer people are paying close attention to the simple fact that all of this requires places to run, capacity to scale, and infrastructure to come online fast enough to meet the promised demand. The market has become so obsessed with ideas that it sometimes forgets ideas need power, metal, cooling, facilities, and operating environments. The picks and shovels are not the whole story. Somebody also has to build the mine. That is where a company like Nebius enters. Now, because it is earlier, smaller, and less institutionally stabilized than NVIDIA or AMD, the stock will behave more violently. There is no use pretending otherwise. This is the kind of name that can move hard on earnings, hard on guidance, hard on financing, hard on backlog news, hard on any sign that the market believes the timeline is compressing or expanding. If you cannot tolerate that, you should not own it. A stock is not immoral because it is volatile. It is simply the wrong tool for the wrong owner. But if you can tolerate it, then you must look at the right thing. Not whether it spiked a lot last month, whether the trend in demand, build-out, and revenue recognition is still moving toward a much larger business. That is the key. I do not need every week to be calm. I need the thesis to remain alive. Nebius, to me, is the throughput machine, the business that stands between enormous AI demand and the physical ability to actually serve it. That is not a trivial place to stand if management executes. Now we come to a name that many people will treat as peripheral, and I think is more important than the public realizes, which is Amprius Technologies. At first glance, it looks like the odd name on the list. NVIDIA, AMD, Nebius, all tied directly to compute AI data infrastructure. Then suddenly here comes a battery company, a smaller one, a more volatile one, less glamorous to the public conversation. That is often exactly where I start paying more attention, because one of the easiest ways to miss major opportunities is to ignore the enabling layer, just because it is not wearing the right costume. Every great wave creates secondary bottlenecks. AI does not only require chips and models. Modern warfare does not only require missiles and drones. New autonomous systems do not only require software. Everything eventually runs into energy density, power constraints, endurance, and the physical limitations of batteries. That is where Amprius becomes interesting. What I see here is a company whose technology may matter first in defense and high-priority government applications, where performance advantages are visible, and where buyers care far more about capability than about ordinary consumer price. That is a very intelligent place for a company to prove itself. Governments will often pay to solve problems the consumer market is not yet ready to fund at scale. And once the technology proves itself there, the commercial world can inherit it later. I like that progression very much. It is one of the cleaner paths from niche capability to broad relevance. Right now, the market is still trying to decide how much to trust the story. That is normal. Smaller companies, especially ones scaling through contracts, production ramps, and evolving government relationships, always invite skepticism. They should. Skepticism is healthy. But again, I return to the same question I asked everywhere else. Is the business moving from possibility to proof? And what I see is a story that keeps getting affirmed by contracts follow-on demand, production scaling, and a market structure that is beginning to support higher levels rather than falling back into the old lower range. That does not mean the path will be smooth. I do not need smooth. I need evidence that the market is learning to value the company differently because the company is becoming something different underneath. That is what interests me here. Amprius, to me, is the energy edge, the part of the next cycle that people will only appreciate fully after they are reminded that power constraints are not theoretical. Then we have the last name, and I understand why it surprises people, Big Bear. This is the kind of pick that makes people uncomfortable because it is not clean enough for the quality purist and not established enough for the conservative investor. It comes with baggage. It comes with a difficult history. It comes with the smell of transition, dilution, skepticism, and unfinished repair work. In some ways, that is exactly why it can become interesting. Markets tend to overpay for clean stories and underpay for stories that have just begun clawing their way out of a damaged period. The key phrase there is just begun. You do not buy a mess because it is a mess. You buy a mess carefully if the reasons it was a mess are actually being removed and the market has not fully repriced that removal yet. That is the bull case here. Not that Big Bear is suddenly some flawless business. It is that the things which made it easy to dismiss may now be less dominant than they were, while the forward opportunity in government AI, border services, defense-oriented intelligence systems, and adjacent contracts may be larger than the market is currently willing to model. That combination can be explosive if it gets any traction. This is also where short interest matters more than usual. A heavily shorted stock with a broken thesis is just a broken stock. A heavily shorted stock emerging from a transition into improving conditions can become a very different kind of asset. It can become an instrument of forced repricing. I do not invest for short squeezes. That is a foolish way to live. But I do respect what happens when the market has leaned one way too confidently, and the underlying business begins denying it the evidence it needed. That is how violent upside can happen. Not because the company became perfect overnight. Because the market was priced for the wrong future. I would still call it speculative. That is not an insult. Speculative simply means the range of outcomes is wider, and the evidence base is thinner than in the larger names. If you own it, size matters. Expectations matter. Discipline matters. You do not marry a stock like this because somebody on the internet found a new slogan, if at all, because you understand that you are buying a transition, not a finished cathedral. And transitions can pay very well if you catch them after the rot has peaked and before the crowd believes the fix. Now let me step back, because the most valuable thing here is not the individual descriptions. It is the architecture of the whole list. NVIDIA is the toll road. AMD is the challenger entering its next economic phase. Nebius is the throughput machine converting AI demand into real infrastructure and future recognized revenue. Amprius is the energy edge powering the next generation of defense and autonomous systems. Big Bear is the speculative transition emerging from a broken period into a potentially much healthier one. These are not 5 random hot stocks. They are 5 different positions on the same broad map, and the map says the market is still only in the early to middle innings of several secular shifts. But fear has reopened the question of entry points. That is extremely important. People love secular trends when they are easy and hate them when they become investable. That is backward. A secular trend only becomes truly interesting once the market stops pricing it as though all upside belongs to the seller and all comfort belongs to the buyer. That is where we are now. There is another lesson here that I do not want you to miss. A lot of investors waste years waiting for the perfect setup, the perfect bottom, the clean chart, the all-clear signal, the analyst consensus, the beautiful macro backdrop. They want a bargain that also feels safe. The market rarely offers both at the same time. Safety is expensive. You pay up for comfort. That is one reason so many people saw NVIDIA's move from the side. They said they loved the business, but they would buy after a pullback. Then the pullback came, but with volatility and uncertainty attached, and suddenly they had new reasons not to buy. The problem was never the price. The problem was that they wanted a price correction without emotional discomfort. Markets do not usually hand those out. That is why I like structured buying. Always be buying, not blindly, systematically. Buy when the market is up, buy when the market is down, buy when the politicians are fighting, buy when commentators are frightened, buy when everybody says this time is different, And when your chosen themes and businesses go through sharp, emotionally difficult corrections, while the long-term logic remains intact, buy more aggressively. That is how you turn volatility from an enemy into a servant. I have seen ordinary people become extraordinary investors, not because they had superior IQs or superior access, but because they learned to respect process over mood. They stopped treating every red month like a referendum on the future. They stopped looking for applause. They built a machine. Money left the checking account on schedule. Shares were accumulated whether the weather was pleasant or ugly. The portfolio was constructed around real themes and reasonable roles. Some capital went to broad quality, some to income, some to growth, some to selective higher risk upside. They did not need to be brilliant every week. They only needed to remain consistent while other people kept changing personality with the tape. That is one of the most underrated advantages in all of investing. Consistency is a bigger edge than brilliance for most people. So if you ask me what is really happening here, I would say this. The market is shaking out weak holders from a set of stories that may still have many quarters and years of runway ahead of them. That does not mean every name on the list wins equally. It does not mean there will be no disappointments. It does not mean valuation ceases to matter. It means the broad conditions under which large gains are often born are beginning to reappear. Fear, volatility, narrative fatigue, strong secular demand, businesses still improving underneath, prices no longer requiring blind faith. That is a useful combination. In the end, what separates the eventual winners from the temporary spectators is not which stock they bragged about in March. It is whether they knew what kind of machine they were buying, what role it served in the larger map, and whether they had the discipline to keep owning it when the market tried to make them feel stupid for doing so. That is the real test. It is always the real test. And the people who pass it usually look early uncomfortable or foolish right before they look right.